Welcome back, and it's time for another Macro Monday where I get you ready for the week ahead in 5 minutes or less. As always, this is just a small snippet of our full Macro Monday newsletter, so if you're looking for more in-depth coverage on the week ahead, I'll provide a link to that in the description of this video. I think you'll really enjoy our full newsletter if you've been enjoying these videos. Okay, so as always, let's start with our chart of the week. As you'll see on the next slide, this week is a pretty quiet one on the economic data front. However, there is one series worth watching, and that is the manufacturing new orders for durable goods. This is a data point that we usually don't give a lot of attention to, but as the chart shows, it often signals where the broader economy is headed. And right now, it's pointing to stronger U.S. growth in the second half of this year. And right now, since everything filters back into the rate cut debate, signs of strong economic growth would make it harder for the Fed to pull the trigger on the rate cuts that the market seems to be expecting at some point in the second half of this year. And that brings us to the economic data calendar. And for the second week in a row, I won't spend the majority of my time talking about the calendar, given how light it is. But that is where we're going to start. We'll get more July regional PMI data from Richmond, Kansas City, and the S&P Global's preliminary market PMI. And last week's Empire and Philly's strong results set a high bar for the regional Fed indices. We'll be paying particularly close attention to the prices paid components as price pressures are back. The Philly Fed prices paid jumped over 17 points month over month in July. So we'll see if the releases this week from Richmond and Kansas City back up that trend. Back to that jump in the Philly Fed prices paid, it put the number just 30% below its inflationary peak. And as a reminder, this was the transitory surge that eventually led the Fed to hike 500 basis points. So they hiked 500 basis points, and yet now the market believes that the Fed is preparing to cut rates. Doesn't make a lot of sense. And yeah, the rate cut story hasn't made a lot of sense to us. And indeed, finally, market expectations are starting to adjust. Just 3 weeks ago, markets priced in a 92% chance of a September rate cut. That likelihood has now dropped to 56%. So while the market still views it as more likely than not, barely, it is a far cry from the near guarantee at 92% from just 3 weeks ago. This move was largely thanks to strong jobs data and a rebound in inflation readings that likely reflect early tariff effects. So the uncertainty surrounding tariffs has increased increased as people wonder what those ultimate price impacts are going to be, not to mention the new tariffs that were recently announced last week. TBD on what the full impact of those is going to be. We sort of keep pushing the clock back. And then finally, adding fuel to the fire in this entire conversation, reports surfaced last week that President Trump had formally explored firing Powell. This sparked a jump in bond yields and a quick rally in gold. And this ultimately caused Trump to back off and showed the importance that the market places on an independent Federal Reserve. I do think that's probably the last time we'll hear fire Powell murmurs. I think President Trump wanted to test it, see what the market was going to do, didn't react the way he wanted it to, and once again backed off on those threats. And that's going to leave you here with today. I hope you guys have a great week. Thanks for watching. If you've enjoyed our Macro Monday video editions, don't forget to subscribe. And I will see you right back here next week for another Macro Monday.